Hello, for Wall Street Media, this is Maria. I'm here with Doug, and we'll help you make money in the stock market with information you can't get anywhere else.
We've got exclusive stuff for you. First off, we've got Rich Gordon that you're not going to see anywhere else. He's a genius, Wall Street respects. And we've got oodles of CEOs today coming to you live from Vegas for B. Riley's institutional conference, right? Their annual conference.
Yeah.
Okay. What do we have with Rich Gordon?
Well, Rich Gordon, he's the income market strategist, and he discusses the proposed restructuring plan for regulating the financial markets and possible effects. Here it is.
Hi, and welcome again to Market Summary Online. On Monday, U.S. Treasury Secretary Henry Paulson proposed the most comprehensive restructuring plan for overall regulatory responsibility for the financial markets since the Great Depression. The plan broadly suggests a three-part regulatory framework for the U.S. financial system. It's organized by objective rather than by financial institution category. Here are the three parts. First, there will be a market stability regulator. This is basically redistributed powers and focus of the Fed. Rather than focusing on preserving the stability of the financial markets by regulating the banking system, the Fed would do it by evaluating the practices of all financial market participants. This would include commercial banks, investment banks, hedge funds, and insurance companies. The Fed would be able to evaluate requirements for capital, liquidity, leverage, and margin in order to maintain financial stability. The second part is a federal prudential regulator. This portion would have a responsibility for the regulation of federally insured financials. Under the proposal, the OTS would essentially be eliminated and the OCC would be rolled under this umbrella. The third part would be a consumer and investment protection regulator. This area would essentially merge the current responsibilities of the SEC and the CFTC. The plan also proposes the following: a Mortgage Origination Commission, a federal agency that oversees state regulation of mortgage originations. Looking at measures to take excess complexity out of financial products and markets. Having rating agencies differentiate in their rating scales between municipal credit, structured credit, and corporate credit. Managing OTC derivatives like CDS. They'll also review and evaluate potentially destabilizing arbitrages by investors. The plan will be heavily debated over the course of the next year, and ultimately the final implementation of reform will be left to the next administration and Congress. Here are some of my thoughts on what it might mean for the financial markets and its participants. First, these types of changes were a long time coming. Since the end of Glass-Steagall, the evolution of financial markets and products has overwhelmed the ability of regulators to effectively evaluate risk and ultimately to protect the integrity and overall stability of the fixed income markets. Second, if the federal government, and by extension the U.S. taxpayer, is going to accept being short a put option for the liabilities of major investment banking firms whose failure would cause systemic instability, then they should have a significant amount of regulatory oversight over these firms. I understand that greater regulation doesn't necessarily mean a more functional marketplace, but I think that reasonable people can agree that left to their own devices, Wall Street firms have significant incentive to enhance their short-term profits with little regard to the potential increase in long-term systemic risks that their behaviors may create. This is why the inmates shouldn't run the asylum, irrespective of the level of their IQs or the size of their paychecks. The current market framework and regulatory structure has failed to prevent a liquidity crisis that has destabilized the financial markets and significantly reduced access to credit. This, in turn, has threatened to hurt growth in the overall economy. Further, the damage to the capital bases of these major banks and financials ensures that the repair bill for the damage done will be footed for years to come. The third thing is that our financial system has been built on leverage and faith. As a result, there's no financial institution in this country that can survive a good old-fashioned run on the bank. The same analysis holds true for the United States government. The continued faith in the efficacy of our banking, regulatory, and risk management practices from our creditors is a key consideration that should underlie our fiscal and monetary policy. In my opinion, the U.S. doesn't have a strong dollar policy. If we did, the twin deficits would be a lot smaller and the dollar would be a lot stronger. If we continue on the path to cheapening our currency to the point where its fiat value is called into question, we'll lose our leadership position in the world in perpetuity. Finally, the financial community has been very innovative in developing new products and structures. It's done more than just increase profits on Wall Street. This technology improved the liquidity and transparency of loans in product sectors that never had those qualities before. It helped reduce rates on all types of loans, particularly mortgages. And those low rates helped drive economic growth. We were able to pull out of the post-9/11 Enron malaise despite the draining effects of an overseas war and rapid outsourcing of American jobs. Unfortunately, together with a worldwide liquidity glut, it also helped fuel so much demand for financial assets that risk in general became significantly mispriced. In order to continue to maintain their returns, investors found new and creative ways to use more leverage. And that's the ticking time bomb. Regulatory agencies and even the institutions themselves that develop these instruments fail to fully appreciate how much structural leverage these new products added to a financial system that was already heavily dependent on financial leverage. The combination of the two creates an extremely short position in credit spread gamma, so macro changes in the economic outlook or liquidity environment invariably lead to instability. Now the Fed will decide just what kinds of structural leverage are acceptable and what the margin and capital requirements will be for any institutions that participate in those products and markets. I expect that the second layer of derivatives, like synthetic CDOs and index tranche products, are going to receive a lot of scrutiny going forward. Thanks for joining us.